Hello, trading has closed on the 20th of April, 2023. We'll do our disclaimer, go over our calls, make some predictions. It's my trading plan for tomorrow, which is April 21st, 2023. Please remember, my calls can be completely wrong. Any trade you make should be at your own risk. I thought yesterday's action was negative. I looked for lower prices at a minimum target of undercutting this low, which we did. That's what we said. When there's early weakness in this pattern, which is the early low pattern, usually that's not the end of the weakness. We've already traded under that. Doesn't mean you can't go lower, it just means you don't have to according to that rule. Now, I know some people might think this is a pattern with the early high, but it's what counts isn't the shape, it's the time. This is a pattern with the early low. If you go back every 32 days, you'll see that there tends to be an early low, a rally, a counter trend drop, and then a rally in the end. Usually the times are earlier, but when there's a gap, and a very, very high percentage of the time, the early low splits. You get two low points a couple hours apart, and all the times get pushed right by about an hour or so. And if you realize at different times, when there's a gap with a split low, you'll see the times work perfectly for the really low pattern. We have a higher target for tomorrow, 41.4509. If you don't gap down smartly, that's my call. During the day, MEJT said this move was false, but retraced. Now says this drop is false, we're going to retrace to this line. Well, we're looking for an ABC here, but there's no way to be certain it's the end of B. It could be just A of B, so let's take a look just in this last leg up. Well, we're right at the end of this channel. Usually when there's a trend line, either you gap under the line or the line wins. So if we're going to drop more tomorrow, you really should gap under this line. If you don't, any move under the line won't stick. Now it's possible to count A, B, and C here, but how do you count what happens after the top this week, a few days ago? Let's switch from the daily chart to a lower time frame. Well, here's a 5-minute chart. Yesterday we had this as 1 and this is a possible 2, but that sure isn't a wave 3 because there's an overlap. So we have to relabel this as A and this is B, and if that is A and that's B, C is right at 1.618 times A. And if you look at wave C, and if that's A of C and that's B of C, you're pretty much right there at the 61.8. So we have good fibs right here. So there's wave balancing out right at this low. Now we gap down, hit a lower low, close over all the lows, even over these lows. It's a rejection of the lows if it's maintained tomorrow. Now usually this pattern will close near its high, and negative. If it's negative, that doesn't happen. But tomorrow's open can substitute for today's close. We've already said if we're going to drop, we really should gap under that upsloping trend line from the channel. So if we're going to drop, we should really gap down under this. If we're going to go up, we really should gap over this. So I'm looking for a big gap at tomorrow's open, promptly trading outside the day's range. We use mixed signals rules. We've already said we think the commonest thing is a gap and prompt move outside the range. Now we have the pattern with the early low, doesn't mean you won't gap up. There's a higher MEJT target. If you don't gap down smartly, the rules say it prints. Now it is negative that today's normally bullish pattern didn't hit a high day in the final hour. So if that's maintained at tomorrow's open, we should lead to lower prices. However, if we gap and promptly overtake the high, that's killed. But everything else I see is pretty positive. It is bullish. There's a higher MEJT target. It's bullish. We gapped down, hit a lower low, closed over the lows. We completed an ABC down. The equity only put the call ratio yesterday. I don't have today's figures. It's over its upper Bollinger Band. That means there's an excess of amateurs buying puts. These guys are usually wrong. SPXA 200R is the percentage of stocks over their 200-day moving average on the S&P 500. Today, one day, hit a high of over 60, spiked down to 31, then recovered all of it to back up to 60 again. And the figures for the whole New York exchange are comparable. That means a large number of stocks traded under their 200-day moving average and recovered immediately. They couldn't hold on to the drop. The afternoon drop was due to a news announcement. There was an announcement that Russia is considering an attack on the United Kingdom. I think that's highly unlikely. But even if it happens, which I'm not betting any money on, moves in response to news announcements tend to be reversed quickly and completely. It's one more piece of evidence that we could gap up smartly tomorrow and overtake today's high. The odds favor a strong gap tomorrow. There are many reasons to believe we'll gap and overtake today's high, but if that call fails, it fails big time. This is the type of environment in which one should consider buying a straddle or a strangle. The premiums are low and the chances of a big move are very high. I just don't recommend specific trades. Option trading isn't for everybody. But if you're ever going to purchase the long side of a straddle or a strangle, this is the type of environment in which you can justify it. Because one side of this trade is going to lose when you buy them. So tomorrow's a pattern with the early low. I think the commonest thing is a gap outside the day's range. If we gap under this low, it's a big break. But I think everything else I see besides the daily pattern points to us recovering this whole ill-timed drop, gapping up smartly and overtaking this high, completing an ABC, and making everybody who bought puts in abundance wishing that they hadn't. Just remember, if I'm wrong, I'm going to be really wrong. And that's today's call.